All right, so today I wanted to talk a little bit more about dividend growth stocks, my favorite kind of stocks. Today, specifically, what I think are, at least that I've came across, the two safest dividend growth stocks in that they're not going to destroy the market by any means, but they're going to be very safe, at least over the long run, for a stock, right? The first one I've talked about before, Canadian National Railway. Again, obviously a railway, one of the two big railways in Canada. And I think that this one's very safe for many reasons. I mean, number one, it has a very consistent track record. Number two, it's going to be virtually impossible to for a new railway to come in and compete with CN, right? I mean, it would be virtually impossible, right? So not only does it have a part of a duopoly, um, virtually impossible for a competitor to come in. And again, it has a very good track record. Again, current dividend yield just under 2%, growing at an 11.6% per year. The payout ratio is 41%. So again, a very healthy payout ratio. Definitely a lot of room to grow still, which is good news. If we compare it to the S&P, it's always outperformed the S&P. If we go back 10 years, it's outperformed by about 10%. Uh, if we go back 5 years, it's actually about even. If we go back, let's say 20 years is not even close. It's absolutely destroyed it. So if we go back about 15, again, absolutely destroyed it. Uh, if we look at the historical yield on cost, again, I stress this over and over again how important it is to buy companies like this and to hold them for the long run, right? Now, again, nothing's a guarantee, right? Nothing's a guarantee. I mean, for all we know, some unforeseen thing could happen. But again, if we go back 10 years, your yield on cost, you're looking at about 5%, which is decent. But we really become good when we go back about 20 years, right? If we go back about 20 years, you're looking at a roughly a 28% yield on cost. Again, that is crazy good returns. Do I think you're going to have a 28% yield on cost 20 years from now? Probably not quite, because they'll probably have to cut the rate that they grow it by a little bit, but I bet you they'll still grow it by 10% over the next 20 years, right? Which means you're going to have a dividend yield over 20%, right? 20 to 25%. So that is a very good yield, right? That's a very good yield. And again, the other good thing about a company like this is that pipelines are not being built in Canada, meaning oil and stuff like that is going to have to get transported somehow, which means there's going to be an increased demand for a company like this. So again, this is one of my favorite stocks to own, if I'm being frank. Again, you're not going to get crazy returns, right? That's just not going to happen. But you're going to get consistency. Right? You're going to get consistency. Although the thing to point out here is that given that consistency, it does trade for a bit of a premium. I mean, the current price to free cash flow is 27, right? So honestly, I would prefer to get it a little bit cheaper than where it's at. But I think it's probably about fair value right now. Maybe if anything, a tad bit undervalued. It is basically right in the middle of its 52-week range, which means again it's probably roughly fairly valued. Although again, if your goal is to hold it for 20 or 30 years, you really don't care about your value. I would just dollar cost average. So again, that's the first one. The next one is one I believe I've talked about before as well. Waste management. Now this one's a very similar. Not in that it's a railway, but a lot of the same things apply here, right? I mean, uh, it has not a monopoly, but a lot of power in the industry that it's in. I mean, and not to mention that, I mean, how many people are, or business people are getting together in boardrooms and saying, the company that I want to start, like a garbage collection. I mean, a glorified garbage collection business. I mean, that doesn't really exist, and like people aren't doing that, right? So that's why one of the many reasons I like a company like this. Dividend yield 1.71%, payout ratio 51, dividend growth rate 8.5. So CN definitely is a little bit better there. Let's go back 20 years, look at the yield. So it looks like it just started paying a dividend in 2000. Sorry, that's the historical dividend yield. Let's look at the yield on cost. If we go back 10 years, actually about an 8%, just under 8%, which is very good. If we go back 20 years, again, it did just start paying in, when did it start? Actually, it looks like it's been paying for a long time. But if we go back 20 years, it's actually only about a 13, 14% yield. So again, it's not growing it as fast, but if we look at the price returns, again, over the last 10 years, absolutely destroyed the S&P, more than double the performance of the S&P there. Let's look at 5 years, still destroyed it, right? Absolutely destroyed it, 90% versus 52. So uh, the stock price return on a company like this definitely is a little bit better than CN, but the dividend growth definitely isn't quite as good. So honestly, let's compare them. Let's compare them directly here just to get an idea of everything. So analysts are a little bit more bullish on waste management, although again that's more of a short-term thing. Again, CN the dividend definitely is a little bit better. Uh, let's see, financial health. Neither one of them is great, but again, given the monopoly powers that a lot of them have, I'm not overly concerned about that. Again, neither one's growing that quickly, although it looks like CN's growing a little bit quicker. Profitability, CN definitely better. Returns, they're about the same. Valuation, again, waste management definitely is. It's got a price to free cash flow of 34. So I would prefer to get it cheaper than where it's at. If you could get it like below 150, that's probably where I would start to nibble at it. But um, a price of free cash flow of 34 is too expensive, right? I wouldn't pay that, right? So the one caveat I would throw out here is you definitely want to wait until that price of free cash flow goes down, definitely below 30, but preferably a little bit more even. I mean, if we look at what's the 5 year average, I'd prefer to get it around there, or if not cheaper. 5 year average is just below 26, so I would wait until it gets around there before I would start taking a position in this company. So again. But the other thing I'd mention, like I say with CN, is that if the goal is to hold it for 30 years, 20 years, probably not the end of the world. I would probably start very slow and then add to it to a higher degree when that price comes down. That's probably what I would do there, because I don't think it's a good idea to get too deep into the woods when it's more expensive. That's probably the way that I would go about it. But that's what I wanted to bring up today. Again, both are very safe companies, right? I mean, not a chance. I mean, very, 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 very unlikely that companies like this are not going to exist and not going to grow over the next 10 or 20 years. Like, very, very unlikely. So yeah, those are what I wanted to talk about today. If you liked the video, hit that like and subscribe, and stay tuned for more.